Good Tuesday morning, investors, Finom Group members, traders, our YouTube audience. My name is Seth Golden, and today I kind of want to offer a little bit of insight into the Finom Group weekly research report. As you can see headlined here, famous quote from Franklin Delano Roosevelt: "The only thing we have to fear is fear itself." And one of the reasons many investors become frightened over this subject matter or that subject matter that may, in the long run, help them to steer clear of large drawdowns or even losses is simply because we don't know, right? We fear the things that we don't know, are unfamiliar with, don't have real insight into other than what the headlines are offering. And as I often say, the headlines are fearful for a reason. They are trying to capture your attention. They are trying to elicit a visceral response from the average viewer, the investor, if you will, portfolio manager. And so again, the only thing we have to fear is fear itself, and largely we fear the unknown. One of the biggest circulating subject matters today surrounds monetary policy. What is our central bank, the Federal Reserve, going to do moving forward with respect to tightening monetary policy as they attempt to tackle inflation, keeping in mind that inflation is part of the Federal Reserve's dual mandate. The dual mandate includes maximum employment and price stability. Price stability is simply a synonym for inflation, right? And we've gone through a protracted period of time where inflation really wasn't a problem. In fact, what we've had more often than not since basically 1995, if not the turn of the century, is disinflationary conditions. I wouldn't call it deflation, even though by and large the CPI has been on a downtrend. CPI is the Consumer Price Index that has been on a downtrend ever since the turn of the century. So again, what is the biggest concern today? Monetary policy and the tightening measures the Fed is embarking on, is implementing. At the last Federal Reserve meeting, or FOMC meeting, the Fed had tightened rates 25, or raised rates, I should say, 25 basis points. Fast forwarding here to a recent quote from Merrill Lynch's report. And as you can see, this is a current projected path for quantitative tightening will sharply contract money supply and inflation over the next 2 years. Here's what Merrill Lynch offers in this regard and on this subject matter. A projection of the Fed's stated goal of running down its balance sheet, running down meaning reducing its balance sheet by $95 billion a month until it drains just over $2 trillion from its balance sheet, and by implication, the monetary base, suggests that money supply growth is likely to slow substantially and may even decline depending on whether excess reserves absorb most of the reduction, or it forces banks to shrink their balance sheets as well. In any case, this quantitative tightening path would leave the Fed's balance sheet just about 15% above pre-pandemic levels and withdraw most of the monetary base increase that funded the massive direct government transfer payments into checking accounts during the pandemic. We believe, speaking for Merrill Lynch, we believe the deflationary impulse this would generate raises the risk of significant economic slowdown. As in late 2018, the Fed may have to back off its QT plans before it finishes to avoid a hard landing. And that's the other concept we tend to hear a great deal about. Is the Fed able to engineer a soft landing, or are we going to have another hard landing? essentially resulting in recessionary conditions. Keeping in mind, the Fed has only managed to effectively generate a soft landing 3 out of the last 10 times it has basically restricted monetary policy. 3 out of the last times it has been able to engineer a soft landing. 6 times we've had a hard landing and or a recession. So this is how Merrill Lynch feels about things. And notice that they highlight 2018, a bit of recency bias, right, folks? When we talk about quantitative tightening, I think many investors recall 2018 was the last time the Fed went an entire year with raising rates. They started in Q1 and they finished in December of Q4, raising 25 basis points in the Fed fund rate each successive quarter. Towards the end of the year, they started to run off or running down of their balance sheet in a more egregious fashion. So my question is this something that we should be fearful of as investors? Often the devil is in the details, as they say. Often recency bias will elevate our fears. As highlighted, 2018 was just a few short years ago. In 2018, we had 2 separate corrections, one at the beginning of the year, about 13%. From February through April or early April, we started to rebound. And then we had a 20% peak to trough technical bear market in the fourth quarter from October to basically Christmas Eve. We hit the lows. And then right after Christmas Eve, the first trading day after Christmas, we came back to a rally that took us through all of 2019. But what most people will also remember from that time period of 2018 is the 4 rate hikes and that technical bear market in the fourth quarter found the Federal Reserve reversing policy, no longer hiking, no longer actively running off their balance sheet. So my last question to investors is this: is there a correlation between quantitative tightening, whereby the Federal Reserve is actively selling assets, right, reducing their balance sheet, and the S&P 500, right? Because if we look at 2018, it suggests there is. And if we look at the periods where they start increasing their balance sheet, i.e. quantitative easing, started back in 2008, 2009, and we know that the markets rebounded in 2009, kicking off the longest bull market in history. That would seem like there's a tight correlation when they're easing and a tight correlation when they're tightening. So that's the question. And the main reason I ask that is because most people are familiar with this chart right here. And it's quite misleading. What we're doing here with this chart is that we're taking 2 different measures. We're taking the S&P 500, the index level. This goes back to 2008. We're starting it at 600. And we're taking the Fed's balance sheet, measured in millions, also at the same time in 2008. We're taking 2 different measurements. And we're using an arbitrary starting point of quantitative easing, QE. And we're running it through 2015 here. And it would appear on the surface that the index level and the Fed's balance sheet, the index is the yellow line, the Fed's balance sheet or Treasury securities held by the Federal Reserve is in the blue line. I think that's blue. And it looks like they're on the same path. But does that mean they're correlated? We don't have the same measurements. The only thing we have is time. We're using two different indexes, but we have the same starting point, but two different measurements. So it looks like the path is the same. And it would lead us to believe that the two are highly correlated because they're traveling basically the same path. Now, here's the problem with this. We can't necessarily tell that just because they're traveling the same path, the rate of change is the same. And that's what we're really looking for with a correlation. If one index changes, is the other one changing in unison? That would tell us whether or not there is a true correlation. So the only way to really do that is to start and finish with the same measurements. An example of another skew chart is right here. Again, we're starting in 2009, carrying it through 2015. Why 2015? Because that's essentially where all quantitative easing ended. The reverse twist idea ended, and actually the beginning of the Fed rolling off its balance sheet or running down its balance sheet. Essentially, the securities or maturities on the Fed balance sheet have expired and they roll off automatically. It's not actively, the Federal Reserve is not actively selling assets, they just reach maturity. And so this chart is basically the same as the one we had just previously looked at. And this starts at 800 million, if you will. And this index, as you can see, we're starting at 0. And again, we're using the same dates, but we have two different measurements, two different indexes. And it looks like they're traveling the same path. The problem with this exercise is as the Fed's balance sheet is changing, we can't tell the magnitude of change in the S&P 500 or the rate of change in unison. We can't do it this way. So what we do is we index. And if you index, you're starting at the same point. You have still two different indices, but if you index them to 100, you're essentially starting both at the same value. Same time and same value. And when we do that, we can see the change for both assets, the S&P 500 and the Fed's balance sheet. We can see the rate of change in both of them is very, very skewed. This does not look anything like our first chart or our second chart here. And in order to develop or extrapolate a correlation coefficient, we need the same starting point. Think of it as if you're going to the track and you want to bet on the horses, right? We can't tell which horse is faster unless they are indexed to the same starting point, the same value position, right? So we have starting gates, and the horses are behind the starting gates. And when the gun goes off, the gates open at the same time, and they travel the same distance. In this manner, we can tell the rate of change for each horse and determine which horse is faster or fastest. That's why we index two different horses. We are indexing two different assets in this manner, looking at the S&P 500 and the Federal Reserve's assets. And as you can see here, this is the Federal Reserve's balance sheet. The yellow line is the S&P 500. And we can see that from 2015, essentially when quantitative easing ended, very, very slowly does the Fed's balance sheet move to the downside. So when the Fed is reducing its balance sheet, actively or passively, we do not see the S&P 500 moving lower with it. And in 2018, when they were more actively drawing down their balance sheet, indeed, we do have this big correction here. But the Fed's balance sheet rundown didn't stop in 2018. It continued through all of 2019 and into 2020, when we finally had to begin quantitative easing again in 2020 due to the pandemic. But in 2019, the S&P 500 recovered even as the Fed's balance sheet was rolling down. So again, by indexing, we have the same starting value, and we can determine whether or not there is a strong correlation or any correlation between the Fed running down its balance sheet and the movement in the S&P 500. If we're looking for the absolute value, we come to find that since 2009, the correlation coefficient between the S&P 500, I think I have it here. Yeah, let's see. Here it is. When using this methodology of indexing to 100 to measure the correlation between the Fed's balance sheet and the S&P 500 since quantitative easing began in 2009, we get a correlation coefficient of 0.036. Now, what does that mean? Well, a correlation of 1 implies two variables move in lockstep. They're perfectly correlated. In fact, you can argue that one is causing the other. When it's negative 1.0, it implies the move in opposite directions. They're not correlated. A 0 implies no relationship. A correlation of 0.036, which is what we've had since 2009, is about as close to 0 as you can get. That means there's basically no relationship between changes in the Fed's balance sheet and the S&P 500. Now, this is using a weekly correlation. And if you don't like the weekly frequency and you want to use the monthly, fine. Your correlation drops to 0.12. There's no statistical significance in the in the movement of the Fed's balance sheet and the S&P 500. So again, you see a lot of these, popularized in social media that makes it seem as if as the Fed's balance sheet goes, so goes the S&P 500. When in reality, if you use the same starting points, you use the same values by indexing, there is no correlation. Now, another argument can be made because we're using an elongated period of time. And I'll leave you with this final note on this subject matter. We know that if you span time, correlations will weaken. So if we condense our time frame to just full year 2009, the correlation is extremely tight. The S&P 500 indeed has a very tight correlation with 2009's Fed rate of change on its balance sheet. Why? Because of magnitude. The Fed massively began increasing its Fed balance sheet in 2009. And when you add that much liquidity and or backstop to the treasury market or credit markets, you're going to get an impulse, a sentimental impulse in equity markets. The correlation in 2009 for just that calendar year between the Fed's balance sheet and the S&P 500 was around 0.80, very tight, almost 1, right? So it was very tightly correlated. So what we learned from this is if we condense our time frames and we take into consideration the magnitude of change during that condensed time frame, you can extrapolate a very tight correlation. So that would be the question that investors are asking today. We know that the Federal Reserve is going to actively draw down its balance sheet, and it remains to be seen how that will affect the S&P 500. Because while we recognize magnitude matters in correlation and time frames, we also really have only a sample size of 1. And I wouldn't, go out on a ledge to accept that sample size of 1 as a rule of thumb, so to speak. Investors need to be open-minded to a wide range of possibilities. But now that you know and you have all this information, we can once again avoid the greatest fear, the things that are unknown. And the reality is the only thing to fear is fear itself. Investors would do themselves a great disservice by selling into corrections, by selling even into bear markets. We know that over time, the market will rise, it will rebound, and it will seek all-time highs. Case in point, the most recent correction was 2020, or bear market, if you will, was 2020. This chart right here starts, as you can see before, right on January 2020, takes us through December of 2020. Imagine, had you sold into this bear market, had you held into this bear market, had you rebalanced into this bear market, and or if you had actually bought into this bear market. That's what the various lines aim to calculate. Each of those 4 possibilities. And so what we see here is the outcome had you increased your equity allocations, you would have gained by year end 14.68%. If you had bought this dip, you would have gained 14.68%. If you rebalanced, locked in some profits, long-term profits, if you will, moved maybe into defensive categories and held those categories or sectors, you would have gained 10.2%. What if you had reduced equity allocation on 3/11? If you had reduced into the teeth of this bear market, you would have only gained 2.03% by the end of the year. What if you had removed equity allocation altogether on 3/11 into the teeth of the bear market? You would have lost 6% by the end of the year. The lesson here is either stay invested and or buy the dip, increase you're getting cheaper prices. The only thing you have to fear is fear itself. And in most instances, you should look at corrections, consolidations, even bear markets as long-term opportunity. Most investors say, well, what if this turns into, the dot-com period? 3 years of consecutive losses. The S&P 500 was down in 2000, 2001, and 2002, essentially cutting, 50% of its gains over the prior bull market period. Most people will resort to the worst case scenario when, they're thinking of risk management. especially when the market is consolidating and correcting. That's what is first or front of mind. But need I remind investors, that is the least probable outcome. Did you know that the only other time the market was down 3 consecutive years, you have to go all the way back to the 1940s, World War II. Don't leap to the worst possible outcomes. That is the lowest probable outcome, and that does not do a service to your portfolio. As an investor, you want to lean into the higher probabilities, not the lower probabilities. With that being said, my name is Seth Golden. I hope you enjoyed this update from Finom Group. And please subscribe to our website here. As you can see, phenomgroup.com. Every week, we have a weekly research report and a state of the market video. Happy trading and be in touch.